screen so you can't see the all right. Hello, folks. We are live. I'm gonna take YouTube's word for it that we actually are live, since they're saying we are. Adjust my camera a little bit. Well, what's going on here? There we go. That's more like it. All right. Okay, so let's, we are live. I'm sharing my screen. There it is. Got a chart of the S&P 500 open in the daily time frame, and got a nice day today. What do we get? Almost 1%, 54 points, pushed up above the prior high, which pretty well negates that downtrend with this new uptrend. Albeit I continue to point out that the volume is simply not coming in on this counter trend rally. So making good strides to the upside, but not getting the volume in there. I thought what we'd look at today is the currencies. Hadn't looked at the currencies in a while. And rather than bringing up one of my existing charts, we'll start with a clean chart. And as I suggest in my checklist here, is start with a clean chart, start with the monthly time frame, and work down to lower time frames. And so that's exactly what we're going to do here. Let's go to the monthly time frame. Well, let's start by getting it on to the US dollar. US dollar, which is DX. Oh, it's not. That's why I'm not. I'm looking at Forex. And what I want is DX, which is actually the dollar index, as opposed to the dollar in Forex markets. And so monthly time frame, US dollar, and looking at the checklist again, identify support and resistance levels. And then we can break that down. We can talk about horizontal and slanted support and resistance levels. Moving averages serve as support and resistance, and then round numbers. I talked about that the other day. The first thing that jumps out to me is this level right here. We can talk about it before I draw any lines on this chart. So what I see is this series of highs, and then kind of a gap in there, and then a series of lows. And so I'm guessing that if I go and draw something like that, just for a starting point, we probably have identified a fairly valid support and resistance level. We can see it acting as resistance. Got a little poke above there. Resistance again, and then a strong impulsive move through that level, and then a pullback to test that level as support. So that's a horizontal support level, clearly. I don't tend to look at moving averages in the monthly time frame, so we won't do that now. The next thing that catches my eye, and I realized the other day that I kind of pop around. I'm not following my checklist step by step. I'm doing technical analysis the way I do, the way I do technical analysis, which these days it's kind of what catches my eye first, and then I spend some time examining that and see where I go. What's going on here? Where's my settings? There it is. Let's look at the original Andrews pitchfork. I've drawn it from these pokey bars, and I've talked a little bit about pokey bars in past sessions. A pokey bar is when we get an upper or a lower wick on a candlestick, and the wicks are indicative of elevated energy. If we think of it in terms, let's zoom in on this particular candlestick. It's a good example. And again, here I am bouncing around. We started looking at support levels, and now I'm talking about wicks and energy. I'm not sure what to do about that. I may do a series of classes, more of a class format than a live technical analysis, where I go step by step by step. And of course, part of the challenge is I don't know where people are at as far as technical analysis. You know, is it ranked beginner, got some experience, and so anyway, not sure what level I'm talking to. So on this particular candlestick, we can see a big upper wick and a big lower wick. And when I talk about the candles like this with the big wicks being elevated energy, sometimes I talk about basically a fist fight. You know, think of the buyers and the sellers meeting in the marketplace and basically duking it out with one another. And so the buyers pushed price all the way up to the top of this bar. And then the sellers came in and they probably started taking profits because they know where the resistance levels are as well. And they had a good trade. And so anyway, some of the buyers are taking profits and the sellers come in, and then the sellers are able to push price all the way to the bottom of that bar. But neither side was willing to commit to, or were unable to commit to, leaving price at this level or leaving price at this level. And so what we end up with is this fat body, short fat body with two long wicks. And so that's my duking it out in the marketplace analogy. So back to Andrews pitchforks. So we got some choices here as to where we might draw this third pivot point for this particular fork. I chose to draw it at this pivot because when I look at this price action, and as I explained before, when I'm thinking about Andrews pitchforks, it's this pullback or counter trend action that catches my eye. So we get this somewhat gentle rise and then a pullback. And so I know from my experience drawing forks that counter trend move is going to end up being the crossbar of my Andrews pitchfork. As we see here, there's the crossbar. Now, the other possibility for where we might put that pivot point is on one of these two bars, because notice that we've got essentially a double bottom there, you know, and so we could talk about that being the end of the downtrend, and yet this bar is at the same level. And so, you know, which of those bars do we choose? There's nothing wrong with looking at both of them. And in this case, what I'm looking for is interaction between price and the median lines of the fork. And so what I see with the pivot at this low point is we get an impulsive push up into and through the median line of the fork, and then a pullback where price tests the median line as support. And so I would say that is price interacting with this fork. Then we get up to the upper median line, same thing, push through, pull back, testing that upper median line as support, fall back into the fork. Some more interaction in there. So anyway, not a bad fork. We'll leave it on the chart for now and head down to the lower time frames. I think indicators, well, we can look at the indicators in the monthly time frame. Why seem to have a delay? I got too much going, I think. And so let's look at moving average convergence divergence, which everybody calls MACD. And so in MACD, we've got both indicator lines above the center line of the indicator, which suggests bull mode. And in bull mode, the primary trend tends to be to the upside, which of course is consistent with the price action that we're seeing here and consistent with the Andrews pitchfork. So whenever we draw a valid Andrews pitchfork, it shows us the trend immediately. Clearly the trend here is to the upside, and we see that in fork. In MACD, we talk about MACD being in bull mode, both indicator lines above the zero level. Currently on a sell signal, and the histogram suggesting that momentum is increasing to the downside because of these dark red bars that are getting bigger, not smaller. And then stochastics is my measurement of energy, and we can see that energy has declined substantially and is headed down to the low level. And so not a lot of energy in the dollar in the monthly time frame. Let's drop down to the weekly and see if there is more information to be gained. We want to reset our fork because we've lost the pivot points. Going from a higher time frame to a lower time frame, the pivot points that we used in the monthly don't exist in the weekly. And so let's reset those. Notice that we've got, again, two price bars that we might choose for drawing this particular pivot point. And I'm between those two bars, I'm going to pick the pokey bar. And so here's a good example of this red bar I would describe as a pokey bar because it's got a somewhat substantial, I mean, it's not big, but in comparison to its next door neighbor, it's got more of a wick than the green bar. And so I'm going to choose the pokey bar there as my second pivot. And then we're back to the same conversation of where do we draw the third pivot? And I'm back to, I think that this is actually a more valid pivot for this particular fork. So in this time frame, let's talk about Andrews pitchforks for a moment. Price has done exactly what Dr. Andrews told his students it would do about 70% of the time. It's going to come from this third pivot point and reach the median line of the fork, and then it's going to do one of 5 well-defined behaviors. And in this case, we get a zoom and a retest. That's one of the 5 behaviors, zoom and retest. And so price zooms through the median line and then pulls back and tests that level for support, finds support, and then it's off to the races again, up to the upper median line. We can see price interacting, multiple candles here where price is interacting with the median line of this fork. So pretty confident that that is a good Andrews pitchfork. Sometimes to increase my confidence in a fork, I look at the other forms, the Schiff and the modified Schiff, and neither of those forms of the fork really blow my skirt up. Not excited about those, which makes me question somewhat whether this is really a useful fork. But it is what it is. Certainly, price is interacting with the median lines of this fork, which would suggest if we were trading this vehicle, the US dollar in the weekly time frame, we'd be looking for a target down here along the lower median line. We'd be looking for a price target somewhere in there. And of course, probably a bounce because we've got both support in this support resistance zone and then support at the lower median line of this fork. In the weekly time frame, I like to look at the 10 and 40 week. Oh, there we go. I'm slow. I've got a delay for some reason. 10 and 40 week moving averages, which really don't add a lot to this conversation. Basically, we got this is sideways chopping action in the US dollar, and not all that interesting. The reason I'm looking at it is because we've had, well, it was the yen carry trade unwind. That's what people suspect has happened, is unwind of the yen carry trade. And of course, that's the currency, yen's currency. And so that's why I'm looking at currencies in this particular session. And again, this to my eye basically is just sideways chopping, not very interesting. I see another potential pitchfork that we can look at just to see if it does anything for us. And there it is, so it did not do what Dr. Andrews told us it or suggested price would do, and that is reach the median line of this fork. Price didn't get to the median line of that fork. So although that looks like you might draw a fork there, it's not a very good one. Fork that would be drawn from that level. MACD again in the weekly time frame, we can see that both lines of the MACD indicator are below the zero level, indicating bear mode. And so primary trend in the monthly time frame still to the upside, but here in the weekly time frame, primary trend is to the downside based on MACD being in bear mode. And we can see the histograms, that's these red bars, and of course the green bars on the other side of the zero line, increasing in size, suggesting that downward momentum is increasing at this point, and of course energy very low. And so based on everything we've looked at so far, reasonable to expect that the dollar will continue heading lower and quite likely reach this target at the lower median line. So that's Andrews in the weekly time frame. Excuse me, the dollar in the weekly time frame. Now we drop down into the daily time frame. Notice that I've left I left my drawings on from the higher time frames, from the weekly and the monthly, and sometimes that's useful because the higher time frame, the analysis that we do in the higher time frames sometimes will frame or provide basically markers or boundaries that are useful in the lower time frames. In this case, I don't really think that that these current drawings are helping us any. So I am going to remove drawings. I'm going to remove indicators and just go back to a clean chart. One of the things that I sometimes do is I get more bars on the chart that are really meaningful or useful. And so in this case, we're down in the daily time frame. Do we really care about what happened in 2023? Yeah, sometimes we do, sometimes we don't. I think in this case, what we're really interested in is what's going on currently, again, because of the yen carry trade and what's going on with it. Let's throw the 50 and the 200 on here. And again, nothing exciting there other than clearly the dollar's not doing well. And I suspect that it's strengthened the yen. We're going to look at the yen next, and I think we're going to find that the yen is very strong currently. That's not a bad Andrews pitchfork. It's steep. And by steep, what I'm referring to is that price, it can go as quickly in upward or downward direction as it wants. It can go straight up, it can go straight down, but the tendency is that price movement is much more gentle than that. In this case, that's probably about a 45-degree angle, this pitchfork, and that is pretty steep for sustained price action. I would not expect price to continue within this fork for a sustained period of time. Price action is just too steep. And of course, to the downside, at some point, it's going to reach a support level and bounce. Excuse me. Lunch has given me the sleepies. Let's look now at the yen, and let's see. We want to look at the yen, Japanese yen, and now we are in Forex. This is the yen relative to the dollar, and we're in the daily time frame, and we're not seeing the strength. We had the strength for the last basically 2 weeks. Of course, this was the big move with the carry trade unwind, and then that looks like just a counter trend bounce, and then a decline again. Let's get volume out of there, cluttering up the chart. Just out of curiosity, and again, I'm not following any particular step-by-step method here. I'm doing analysis the way I typically do, which is I see what catches my eye, and I pursue that thought for a minute or two and see if it leads anywhere. So what I'm noticing here is that we get a big impulsive movement to the downside, and then this counter trend bounce. And so that makes me think of Fibonacci retracement. And so if we go, let's start at that pokey bar, excuse me, and pull it down to the low of this pokey bar. And so what we're measuring with the retracement tool is this impulsive movement to the downside, with the expectation it's we could talk about reversion to the mean, which essentially that's what Fibonacci, the retracement tool, is showing us. It's retracement towards the mean, counter trend bounce, if you want to look at it that way. And so there are common levels that price in whatever the vehicle is, doesn't matter what the vehicle is. There are common levels where price reaches on a rebound. And what we see here is the 38%. That's the first Fibonacci level. And we can see that price just exactly touched that level on the uptrend, and then found resistance at that level and then fell off. And I mean, that's a really pretty example of Fibonacci retracement. One of the reasons, and this is an important detail when you're dealing with, whether it's the Fibonacci tools, Andrew's pitchforks, the more elevated energy is, the more valid the usage of the tool is likely to be. And so in this case, we've applied the Fibonacci retracement tool to an extremely impulsive price movement. That's a big impulsive price movement. And so not really surprising that we're seeing price react at the 38.2% level. So the first Fibonacci retracement level. Quick note, the 50%, that's a halfway move, and that actually comes from Dow theory. It's not part of Fibonacci, but most charting platforms include the halfway mark on the Fibonacci tool, but that comes from Dow theory. So let's see, is there anything else we want to look at? Let's throw, I'm seeing another potential pitchfork, which is right there. And zoom out a little bit. So we can see price reached up to the median line, pulled back, found resistance again, zoom, retest that failed. And so now price is back below the median line, dropped off again, pushed up. And so anyway, that's a pretty good fork. And so if we were paying attention to this vehicle and had this fork on our chart, there are a couple of indications that if we were paying attention, we might have noticed that this was my target. This would have been my price target. I would be expecting price to reach the upper median line of this fork, and it didn't. And then it fell off. And so the fact that price did not reach its next Andrew's pitchfork target, the upper median line, indicates or can indicate that behavior is changing. Basically, this uptrend that was in place is no longer in place. And now this vehicle price is going to go do something different. And in this case, a dramatic move to the downside. And again, so now if we're down at we're finding support along the lower median line of this fork, and then a failure at that level. And so when price moves decisively through a median line, the next target becomes the next median line in the series. And so in this case, this is the lower median line extension. And we can see prices finding support at that level. We got a brief poke below, and now that level appears to be providing support. So that doesn't really tell us much. I was hoping to see more from looking at those two currencies. The other currency of interest, of course, there are 6 currencies in the U.S. dollar basket. The U.S. dollar, there is no such thing as the U.S. dollar unless we're talking about the paper fiat currency that we carry around in our wallets and purses. We could talk about that being the U.S. dollar. The U.S. dollar in the financial markets is actually a basket of 6 currencies, and it's the yen, it's the euro, the yen, Swiss franc, Canadian dollar, and I'm pulling a blank on the other ones off the top of my head. Key ones are the euro and the yen. And so let's look now at the euro in the Forex markets, euro USD, and see what's going on. Okay, so strength in the euro, and so that explains, or could explain, why we're seeing weakness in the U.S. dollar because of the strength in the euro. That's one possibility. First thing I see here, and again, we're still in the daily time frame, I see a potential Andrews pitchfork, and that's not bad, but let's have another conversation about Andrews pitchforks. This is another example of, we've got more than one choice of where we might draw this particular pitchfork. As I was pointing out earlier, what catches my eye, the first thing that caught my eye was this pullback, but then I noticed that really we could look at that whole movement as a pullback. And so we've got 2 choices for a pivot point for our Andrews pitchfork, that one and that one. And again, nothing wrong with looking at both of them. When I learned Andrews pitchforks from Dr. Timothy Morge, what he talked about in this scenario was using the high of the move. That's this point is higher than this point. So that would be the normal pivot point for drawing an Andrews pitchfork. Dr. Morge talked about using the width of the move to draw a pitchfork, and that would be this pivot point, even though this is not the high of this price movement, it's over here. This encompasses the full width of this pullback. And to my eye, that is a much better pitchfork. So look at this one. Let's compare them. We'll draw another pitchfork and use the other pivot point. Thusly, change colors so we can see the difference. And so if we talk about this blue pitchfork, price is interacting with it, but it's kind of sloppy. It's kind of sloppy. Price action. There the blue fork catches the low. We can see price finding support, resistance, support. So, price is interacting with that fork, but I believe that this is a much more useful Andrews pitchfork. We can see today that the euro was finding resistance at the median line of this fork, and now has pushed above that level and done so impulsively. This is an impulsive price bar, at least at this moment. And we know that it's an impulsive price bar because price is almost at the high of that candlestick. So there's a little bitty tiny wick at the top of this candle, but essentially price is at the high of that bar, which is an indication of elevated energy, an impulsive price bar. So let's look at the MACD and stochastics. There's MACD, there's stochastics. We scrunch that down. And so MACD in bull mode, both indicator lines above the 0 level, clearly on a buy signal, and climbing sharply. So a lot of momentum to the upside. If we revisit the conversation that we had last week about prior highs in MACD serving as levels of overbought and oversold. And so we can draw that line in as a potential level where MACD becomes overbought. And typically, or quite often, when MACD becomes overbought based on a prior high, price rolls over and reverses. And so we can see, let's compare this MACD to price. And so if this is our overbought level, notice that price reaches a peak and then pulls back. And so we almost get back up to that same level of being overbought. Price peaks and pulls back. There's another peak, pull back, peak, pull back, a secondary peak and a pullback. And so anyway, the what I'm looking for is how far does MACD have to go before it reaches this level of becoming overbought again? And it's got a ways to go, fair ways to go. And so anyway, this upside movement could continue for a ways before running out of energy based on the MACD indicator. As far as upside targets, next thing I would draw is this resistance zone. So it's not a support zone yet because it hasn't been tested as support. So all we can say is that this is a resistance zone where price, the euro in this case, may run out of energy and either transition into a sideways movement or pull back, get a pullback from that level. So that would be an upside target if we were trading this thing. Of course, we're late for the move. You might say we were late for the move. Or if you were a breakout trader, you might look at that as a breakout above the median line. I'm not a breakout trader. So is there anything else we want to look at in the currencies? Not that I can think of. Let's see. So I am going to return to the equity markets because they are interesting at this particular juncture, because I'm still of the opinion that this is just a counter trend movement. Strong, it's a strong counter trend movement, um, and maybe I'm just holding out too long. As I was saying earlier, this move today has pushed up above the prior high, this point, and done so decisively. So that's an indication that this move may continue. And of course, energy is elevated, so price has energy to move higher if it wants to. We've got MACD, we've got the signal line up above the zero level, but the moving average still down below that level. So kind of half and half, bear and bull mode. So that's S&P. Let's grab the Dow. Let's grab the Dow. Hello, the Dow and the Nasdaq. See what they did today. Another good move, strong move. What's that? 0.58%. But notice that we've still got we've still got a lower high so far. You know, price reached, this was our prior high, and so far we have not we've not climbed above that level. And so we could still talk about this movement being a counter trend movement. But it's certainly a strong counter trend movement. MACD in bull mode on a buy signal, energy very elevated. And of course, we got a couple of things going on. We're at the end of August. It's the 19th of August. And so September is, that's typically when we think about the summer's over. The traders are back at their trading desks. They've had a nice summer. They're ready to trade. And so, activity picks up in September. And then the other thing is this is an election year. And if you believe that markets are manipulated or managed, however you want to think about it, the level of that management, not unreasonable to think that the management level would increase in election years. Basically, we want the markets to look good coming into an election, and so pull out all the stops to make the equity markets look good. And of course, the Dow is the most widely followed index here in America. And then another thing that's going on right now, multiple corporations have large stock buyback programs in place. Apple alone has got $110 billion. They announced that at their last earnings release. And then I saw a couple of different analysts saying that the current level of corporate buying is $5 billion a week. So we've got, these corporations with their buyback policies currently buying $5 billion worth of stock a week. And of course, when price is depressed, down here, that's a good time for a corporation to step in. If they're going to buy their own shares back, buy them on sale, buy them down here. So makes some sense that the corporations buying their own stock down here. Up here, does it still make sense? Don't know. And then a third thing going on in the equity markets right now. I'm just pulling a blank. What do we got? Oh, expectation of rate cuts. And so we're back to people expecting the Fed to cut rates again. And I don't believe that's going to happen. But that's one of the if you go out and read the analysts, they're talking about rate cuts and multiple rate cuts. Oh, and even debating about whether the September cut will be a quarter point or a half point. And so not only are we going to get rate cuts, but we may even get a 0.5% cut. And that's not what I expect, but what do I know? So anyway, that's another reason that stocks are moving higher, is that people are expecting the Fed to cut rates. And of course, I would, one of the questions I might ask is, is that healthy? If stocks are only moving higher because the Fed is going to cut rates, is that really a good thing? And of course, it just depends on your perspective. Let's look at the NASDAQ, since that is the tech stocks and the AI bubble. What do we see here? Another strong move, 1.3% today. Continue push up past this prior high. So again, has basically negated the idea that we are in a technical downtrend, which again, a technical downtrend, we get a high, a low, a lower high, and then a lower low. Well, the next step in a continuation of the downtrend would be another lower high and then price rolling over. That's not what happened. We've now got a high that is higher than the prior high, so we're not in a technical downtrend anymore. And so really, it's not appropriate to talk about this being a counter trend rally either. This is a rally to the upside, and a high energy one. All of these gaps, as I pointed out before, to my eye, they're an indication of volatility, and that makes me that would make me concerned. If I were invested in the stock markets, I might be concerned about the amount of gaps that we're seeing in the tech stocks. If we were strictly talking about gaps, there are at least 3 different types of gaps that we can talk about. And let me throw a text up here and type them. So we've got simple gaps. We've got breakaway gaps. Breakaway, if I could spell, runaway gaps, and exhaustion gaps. And so in this case, we've got a couple of those that we can talk about. So a simple gap is here. So we've got, in this doji candlestick, price closes on the crossbar, and then when the next session opened, price gapped upwards. And so we could talk about that being a simple gap. But then just 2 bars later, we get another gap. And so when we start seeing a series of gaps, we can talk about breakaway gaps or runaway gaps, that basically there's enough energy for price to continue, whether it's higher or lower, and continue with a series of gaps. And so that's the basically runaway gaps. It's a series of gaps as price makes its move. We could talk about this being a series of runaway gaps to the downside. Now we've got at least 2 gaps moving to the upside. So high energy in the tech stocks. Sigh. Not what I was expecting to see in the equity markets. But again, there are several reasons. And reasons isn't a good word. We shouldn't be talking about reasons for price movements. Several different ways that we might explain the price action that we're seeing there. And probably the 2 strongest ones would be the expectation of rate cuts, and then it's an election year. So let's look at Not seeing, not seeing any comments there. So let's look at the precious metals. They did some nice action today, or continued the action. They broke above, or gold. Let's talk about gold. Gold broke above 2,500 on Friday's close, and I was a little bit surprised. Well, two things. First, that price closed above that level on Friday, because wouldn't have been surprising to see, price poke up to a new high and then get pushed back below the 2,500 level, but that didn't occur. And then another, I won't say that it's frequent, but not uncommon, that in the middle of Sunday night, the forces that like to manage the precious metals markets, they come in and sell a whole bunch of futures contracts in the middle of Sunday night, which of course is the lowest volume session of the week. And so a profit motivated seller, somebody who wanted to sell what they owned for profit, would not choose the lowest volume session of the week to do their selling. They would choose the session with the highest volume, because that's where they would maximize profit. And so anyway, when we see a big batch of selling in the middle of Sunday night in silver or gold, that is management. You can call it manipulation if you want, management, whatever word suits you. But anyway, that was the second surprise, is that we didn't get a big price smash in the middle of Sunday night. Instead, what we see is that the price of gold is finding support at the 2,500 level. Currently, price is at 2503.80, so above the 2,500 level. And this doji candlestick with the body above 2,500 suggests again that price is finding support at 2,500. I was listening to a podcast. It was an interview of Bob Moriarty, and he was suggesting that China, via the Shanghai Gold Exchange, has put a floor under the price of gold. And so that may be part of what we're seeing here, is that China has decided that the floor in gold is now 2,500. And so that's what we're seeing. I have to caveat that price remains very overbought in gold based on the three moving averages. This is a big space between the 50 and the 200-day moving average. This condition typically does not sustain for a long period of time. We can see here the 50 gets extended above the 200 and then pulls back. We go back as far as you want, gets extended below, in this case, below the 200, and then pops back. And so anyway, the 50 is quite extended from the 200, but gold is strong. And so more likely that we're going to see the 200 continuing to rise and try to catch up with price. I don't think it's going to. I'm actually expecting gold to put on another $200 or $300, and could do that quite quickly. Would not surprise me to see that happen quite quickly. So bull mode in MACD, elevated energy. So gold's just looking real good in the daily time frame that we're looking at. And of course, it's looking good in all the other time frames as well. This is silver. Silver had a nice day. Actually, silver's had 3 nice days in a row. the positive action, or the nice action that I see from today, is that price has pushed decisively above the 50-day moving average and closed at that level. So yesterday was pushing up towards that. And of course, the 50-day moving average, as I show in my checklist, support and resistance moving averages. So the 50-day moving average is a common support and resistance level. Lots of traders are looking at that moving average and using it in their trading decisions. And so not uncommon to see price interact with the 50 and the 200 and then the 20 as well. That's the light blue line. So anyway, this is positive action, in my opinion, that price pushed decisively through the 50 and closed above that level. Of course, we've still got another resistance level, which is the median line of this modified Schiff pitchfork that we're seeing here in red. And so not unreasonable to expect some resistance at that level. And of course, this whole zone is a support resistance zone. But silver is moving quite strongly. I mean, that's three strong price bars there in the last three sessions, and so that's nice action in silver. MACD still in bear mode, suggesting that the primary trend is to the downside. And to be fair to the equities, we'd have to describe silver as being in a technical downtrend still. So we talk about high, low, lower high, lower low, lower high. And so until price rises above this level, silver is still in a technical downtrend, and that's supported by MACD. Albeit price based on MACD reached a very oversold level. So when price was down here at the 200-day moving average, MACD was extremely oversold, and not unreasonable that it would bounce or reverse from that level. More than just a bounce, an actual reversal up to the upside, very elevated energy. And of course, we didn't need stochastics to tell us that energy is very elevated. We see it right here in these three price bars, three impulsive price bars. Well, this third one's not really big enough. I wouldn't, a little bit hesitant to call that an impulsive price bar. But the three of those bars together, I'm comfortable saying that is an impulsive price movement. And what I'm looking at now is three soldiers, Japanese candlesticks. I like the Japanese candlesticks. So three white soldiers. They're showing us an example here. It's basically three. They're showing white on my chart. These would be green. So we get three strong price bars in a row like that, and that gives us another indication of strength, elevated energy. So, and they're saying as a reversal indicator, appearing after a period of price decline. And so any number of ways to trade the markets, do technical analysis. Some people focus strictly on Japanese candlesticks and maintain that that's all they need to trade successfully. Dr. Morge, he never had any indicators on his charts. But he would point out that all the action you need is right there in price. And that's true. And so if we talk about, for example, the unwind of the yen carry trade. So we can look at charts that show us the Japanese yen and the Japanese bond and the U.S. dollar, and any number of different ways to look at the unwind of that carry trade. But Dr. Morge would point out we don't have to look at all of those charts, don't have to look at the indicators, because all of those decisions, all of the decisions that traders will make as the yen carry trade unwinds will be reflected in the price action. And so we don't need to look at these indicators, don't need to look at anything other than the price action. And of course, he was a big proponent of Andrew's pitchforks. So Dr. Morge actually learned from, as a young adult, late teenager, young adult, I forget exactly what age he was. He was able to attend in person some of Dr. Andrew's earliest workshops. And so Dr. Morge learned Andrew's pitchforks directly from the man who developed Andrew's pitchforks. And so I feel fortunate that I was able to learn Andrew's pitchforks from Dr. Morge. And of course, he's passed on. So rest in peace, Dr. Morge. Thank you for sharing your information, which certainly didn't have to. He's a very successful trader for 40 plus years. And he taught because he loved to teach. He actually had, interesting man, three PhDs from the University of Chicago. And I forget, one of them was mathematics. I forget what the other two degrees were in, but very, very smart man. Yeah, again, rest in peace, Dr. Morge. Let's see, it is 2:15. We've been at this for an hour. I haven't added anything to the checklist here. It is up on the website for download. If you'd like to, I'll pin a comment in the comment thread on this video with a link to the download for this checklist. And let me stop sharing my screen and wrap this session up, and I will see you. I think I'm going to do these sessions, or at least do another one at the same time tomorrow. So, and I'll schedule that. See you, folks.